Welcome to the Flow Tracy Money Audio Commentary. This is Owen Tracy recording, and it is 3:45 p.m. that is Central Time. Today is December 8th, and I thought we'd kick off with the 10-year yield today, because when we look at the weekly chart, it's at a new incremental high. So that very briefly breaks that sequence of lower rally highs, but not in a dynamic manner. And I think we're at a rather interesting juncture here, and it probably is better to look at all this on a daily chart, because the last time the Federal Reserve cut interest rates was at the end of October. It was the 28th of October. So when we then think about what was happening, well, right around the 28th, the yield was below 4%, and not that far off the lows back in April. And then following the interest rate cut, where you would normally anticipate that yields would contract, in fact, they went up. And over the course of the next week, they got right back up to test the 4.16% level, or the upper side of this range. And that set the cat among the pigeons. So we had a little bit of weakness in the stock market as well. In fact, it was immediately after the interest rate cut, the day after the interest rate cut, that the Nasdaq hit an all-time new high. And over the course of the next 3 weeks, it dropped by almost 9%. So it didn't really start to rebound until the speculation around the potential for Kevin Hassett to become the next Fed chair really started to pick up. And after that, yields started to contract again. But now, as we head towards the interest rate decision from the Federal Reserve on Wednesday, yields have been backing up again. They got all the way back down to just below the 4% level right at the end of November. And for the first week in December, they've gone right back up to test the 4.2% level. Now, this I think is rather interesting because it was widely described as a hawkish cut to interest rates at the end of October. And really, what does that mean? Well, it basically implies that the Federal Reserve is cutting interest rates, but they're not particularly happy about it, and that they are fully cognizant that there's an inflationary issue that hasn't quite been dealt with, and at the same time there are employment issues which are looming, and at the moment they are favoring the employment argument. And of course, then you have the additional issue that because of the government shutdown, there are a lot of data points which are being delayed and then will probably be reassessed later down the line when there's more data available. So we're at a rather interesting juncture for the bond market and the equity markets. And I suspect it's quite likely that this is going to be another hawkish cut. And then there's this broad perspective about how dovish